Joining us now on the state of housing is Jonathan Wallachin. He is the head of U.S. housing at UBS Global Wealth Management. Jonathan, welcome. Nice of you to join us today. Do these numbers surprise you at all, or are they basically reflecting sort of pent-up demand, people who weren't able to go look at houses in March and April and those months?
Well, first of all, thanks for having me, Tyler.
You're welcome.
I think there's some surprise in them in that, given the fact that we're staring down the barrel of north of 12% unemployment, logic would have dictated that probably sales should have been lower. But on some level, they're not surprising for a couple reasons. One, if you really dissect the data and you look where the sales occurred, a lot of them occurred in the southern states and the Sun Belt markets, which have really been the beneficiary of a lot of population and job growth. And number two, as Diana pointed out, interest rates are incredibly favorable. For the highest quality borrowers, we broke below 3% for the first time in 50 years. And also the dearth of available supply has definitely sort of helped that. Finally, I think the last thing that has helped is a lot of states have begun to remove the lockdown and in-person viewings. Mm-hmm. And, when we kind of layer onto that, what we've heard from some of the public home builders in terms of activity there, there's not complete surprise there.
Where do you see, I mean, you mentioned the idea that people are maybe migrating to the South. That's where population growth has been. That's where job growth has been. Are you sensing a move from the urban cores to the suburbs as people may not feel as comfortable being in crowded vertical living environments?
Yeah, it's an interesting question. And we try to break down what we think is structural versus kind of cyclical. Mm-hmm. One thing that we think is an actual structural move is the move from what I get people would call blue states to red states. And if you look at the data over the last 10 years, you have seen a move out of the 5 highest tax states into lower tax states, whether that's in the East or the West. I think, and that is clearly a structural trend that we think will continue. What is more cyclical in our view, and time will tell what kind of legs this has, is that move from the dense urban environment to suburban. I mean, I live here in Westchester County. We clearly have seen some of that, but I think it's always a little, one has to be careful in making the judgments during the middle of a crisis. And go back to 2000, right after 9/11, what did we hear? No one would ever fly in a plane. No one would live in a high rise or work in New York City. So the key is once we have a vaccine, it's very possible we could see a reversal of that trend.
Mm-hmm. Median prices are high at I guess, records. Let's talk a little bit about what may be happening at the lower price levels of the market. Because while there are lots of buyers out there, there are also a lot of people who are now without jobs or have seen their hours cut. There are a lot of people who may be in danger of foreclosure. Are you concerned about that wave hitting shore anytime soon? There have been foreclosure moratoriums under the federal borrowing programs, but what are you seeing there, and how do you factor that into your outlook?
Yeah, fair. And so like the entry level or a kind of more affordable price point has clearly been the strongest part of the market. And one of the reasons that we entitled our report Defying Gravity is because if you look at the vast majority of the layoffs that have occurred, they've occurred more in service sector jobs, which tend to be on the lower wage scale. So if we are to get an increase in unemployment in higher wage jobs, that could be a risk for the more entry-level market. As far as foreclosures go, about 75% of the mortgages out there are ultimately either backed by Fannie Mae, Freddie Mac, and the FHA, and their moratorium programs have basically said once forbearance ends, then you won't have to make a bullet payment or a balloon payment. That's really good news, but that does leave 25% of an $11 trillion market that is in the hands of either balance sheet lenders or private label mortgage-backed securities. And from that perspective, there is no consistency in how the period will end. So certainly there are risks going forward.